Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Reid Goossens. He is a real estate investor, entrepreneur, author, podcaster. His book is called Investing in the U.S., The Ultimate Guide to U.S. Real Estate, and his podcast is also called Investing in the U.S. Welcome to the Money Answer Show, Reid.
Thank you, Jordan, for having me on the show.
You have an interesting story. You didn't start in the U.S. Just kind of briefly tell the story of where you came from and how you got established in U.S. real estate.
Yeah, so as you can probably hear from my deep southern accent, I'm not originally from America. I'm from down under, and I moved to the United States about 7 years ago for two reasons. One was for love, and the other one was for career. My wife is American, and I moved here. At the time, she was my girlfriend, and I moved here, quit my job in Australia, and quickly got a job as a structural engineer because that was my former career. And I made the leap, and within a very short space of time, I had acquired my first bit of real estate because the barriers to entry here in the United States are just so much lower compared to where I come from in Australia.
So there are many different kinds of strategies in real estate. Do you do many of them, or do you specialize in a particular strategy in real estate?
Yeah, look, really good question. I started out with, buy and hold and cash flowing. I've tried a bit of flipping. I've done some ground-up construction in my former career. But now I focus purely on real estate syndication. And for those listeners who may not know what that is, it's where we pool investors' money together. I'm the managing member, and we go out and buy larger assets, maybe that we couldn't afford as individuals, but as the power of the group as a whole, we can go out and buy these bigger and more safe investments so everyone can cash flow and hopefully get a good return on their money.
So what is the advantage of doing syndications as opposed to, say, individual single-family home fix and flips kind of thing?
Yeah, good question. So, look, in the general scheme of things, who we focus on when we try to attract the investor is the person who's the busy individual who may not necessarily have the time nor the energy to go out and find really awesome real estate deals. Don't get me wrong, you can make a lot of money in single-family houses, buying and flipping and selling them. But if you've got to own them for a long period of time, we have found that commercial real estate is a lot safer. And when I say mean safer, it means that, if you have a duplex or a triplex and say one or two of your tenants move out, then you're over 50% vacant. The likelihood of that happening on, say, a 100-unit apartment building is a lot lower. So we can get more attractive financing. Obviously, to buy a 100-unit apartment versus, say, a triplex or a single family is a big delta between the two. But that's where we bring the power of the group and the crowd together in order to pull our money together and go and buy this 100-unit asset. I manage it with my business partner, and everyone gets the benefit. It's a win-win situation for everyone.
So is that the minimum size that you do is 100 units?
Typically, yes. When we first started out, it was a lot smaller, 30 to 50 units. But now, the amount of work that we have to do as the managers, it just makes more sense. There's more scale if we can go get something over 100 units. Pulling together a syndication, obviously, as you could imagine, requires a lot of work. And if we do a 30-unit, we're doing just as much work as if we're doing 100 units. So we typically, aim to, and there's more pie to go around, right? If there's 100 units compared to just 30 units. So we typically try and stick over 100 units, institutional quality assets, so built in the 1980s or 1990s or early 2000s. And we look to add value to these assets by doing a number of things through, renovating the apartments and increasing the rent, adding better amenities to the property, maybe being more efficient with the consumption of utilities on site. There's a whole laundry list of things we come and do to increase value and essentially increase the net operating income of these assets, because that is what these commercial assets are valued on. They're valued on their NOI, net operating income. So, yeah.
So let's talk about the investor side a little bit. So for people investing with you as part of the syndication, what is the minimum investment, and do they need to be accredited? What does an investor need to bring to the party?
Sure. Yeah. So typically our minimum investments are about $50,000 each. So we keep it relatively low so investors can diversify across a number of our deals. Now, every deal that we pull together, we raise the money for that specific deal. We're not raising a blind pool and just saying, oh, we're going to go buy, X amount of properties. We've identified the property, we put it on the contract, and then we go and raise our money from our investors, from our investor database. And, so investors can put $50,000 in, say, property A, they can put $50,000 in property B, and that might be in a completely different market. And so they can be more diversified across a number of assets rather than being in a pool where you may not necessarily know where the money's going to. So we've already identified the asset and help investors, diversify across a number of assets when they come and invest in our company.
Do they need to be accredited to invest or not?
So we are still doing, all accredited investors. We do have a small handful of non-accredited investors. So we do 506B for Bravo. And those non-accredited investors are typically our friends and family, and all the accredited. But we only have maybe 5 to 10 investors in any one deal that would be non-accredited. The rest would be accredited investors. And for those people out there who don't know what accredited means, just earns $200,000 a year or more as an individual, or is worth $1 million, excluding the value of their personal primary residence.
And what kind of returns are they earning on the properties you're syndicating these days?
Yeah, so the way in which we set it up is we set it up a structure where investors who bring essentially the down payment and typically the capital expenditure and maybe a little bit of operating account, so let's call it, say, 35% of the overall purchase, and we get the bank loan for the rest of it. Investors will get a preferred return of about 6 to 8%, depending on where the deal is and the type of deal. And that's every year. We will, in a preferred return, you can't ever guarantee anything in real estate, but it's the next best thing. So it's the first X% of cash flow from the property will go straight to the investors, and then anything over that X%, whether say it's call it 7%, anything over 7% cash flow will be split 70-30, 70 to the investors and 30% to us, or myself and my partner, we're the general partners, and we are it's called the GP, and we own 30% of the deal. So investors own 70% and we own 30%.
And what is the length of holding period that people should expect in a building like that?
Typically 5 to 7 years. We are looking to try and 1.8 times to 2 times investors' money in that period of time. It just depends on obviously where the market is, the value add strategy. But we are definitely looking, as we're coming into a tighter market, to hold the assets for a little bit longer. Before, maybe a couple of years ago, we were maybe projecting 5-year exits. Now we're sort of projecting 7 to 8 year exits. And so people have to understand that it is an illiquid investment, but it suits a lot of people. We have a lot of people interested, with the self-directed IRAs. A lot of people just want to place their capital and just keep it compounding over a period of time, and then they don't really have to worry about it. So overall, we're looking for a 13 to 15% IRR, 1.8 to 2x investors' equity over a lifespan of 6 to 7 years, typically.
But you do plan to sell the buildings in 5 to 7 years eventually. They will get their principal back.
That is correct.
Yeah.
Yep.
So if you're in an IRA and you have money in there and you're getting monthly cash flow, how can you reinvest that?
You can reinvest it in if it's significant enough. You can reinvest it in another deal we may have on offer. But right now we just typically pay the dividends back, and however that just keeps accruing over time. And if it accrues over a period of say 3 years, and they build up a nice little nest egg, and they want to reinvest another $50,000 into deal number 2, they can do so as they wish.
I see. So the advantage of this is diversification and professional management, and it's kind of a passive income for the people who are investing. Is that right?
Exactly. That's exactly right. Everyone's all our our LPs, limited partners, but also AKA investors. They are passive. They don't lift a finger. They have no debt risk. They don't have to go to the bank and ask for bank loans. We, as the general partners, my business partner and I, we go and do all that. So we put our necks on the line in terms of we bring the deal to the table. We bring equity in terms of we co-invest with our investors, and we also bring the bank debt to the table. So we're bringing a lot to the table, and investors then get to benefit from us because of our expertise. But we get to benefit from them because, as again, we're syndicating, we're using everyone's money to pull it together to go and buy these large assets.
Okay. So if people wanted to find out more, is there a website they can go to, or where would they go to find out more about your syndications?
Yeah, they can head over to reidgoossens.com. They can drop me a line, and we can chat from there. There's my actual the business part behind it is called wildhorncapital.com. But if you from a marketing point of view, you can just head over to reidgoossens.com and drop me a line just there.
So lately, interest rates have been rising, and that's been hurting real estate sales to some extent. How does that affect apartment buildings differently than single-family homes?
Yeah, very good question. Look, the way in which we look at it is that apartment buildings, as interest rates, particularly the Treasury rises, we are expecting to see capitalisation rates soften. They had typically been in the 5 to 5.5% on a Class B asset, which is sort of built in the 90s, in secondary markets across the country like your Dallases, San Antonios, Charlottes, those type of sub-markets. But as the Treasury goes up, we are expecting that cap rates will expand again. Typically, hopefully, back into the 6 to 7%. But there's typically a lag, so we haven't seen. There's not an immediate turning on a light, the Treasury rises and all of a sudden cap rates rise. There's still a lot of sentiment in the market, particularly sellers, that they can get the biggest bang for their buck. But I reckon in Q1 or Q2 next year, we will see that softening in the cap rates and in AKA sales prices of these assets. As we're coming into maybe a higher interest rate time, as we've typically been in very, very low interest rate, historically low interest rates for the last 7 to 10 years.
So that means that the returns will be lower if the cap rates go up, correct?
Well, not necessarily. Depends on how you analyse the deal. So if you are buying a deal at a 5.5 cap right now, the way in which we look at it, it has to be true value add. So it has to be, things in there that you've got to go and you can bring it up to bring the rent up to market by doing renovations, putting in new flooring, putting new cabinets, those sort of things, and you want to be able to get a rent bump for that. And if you can do that across, call it 200 units, then you should be able to increase the net operating income. Now, obviously, you've purchased a building at a going-in cap rate. If you assume a cap rate expansion, so you're assuming the market's going to get worse in, say, call it 5 years' time, and you exit, you use that year 5 NOI and you divide it by an exit cap rate, which is obviously an assumption. I typically underwrite, as should everyone, particularly in these uncertain times, that there should be a cap rate expansion. So if I'm picking it up at 5.5% today, I will expect probably a 10 basis point expansion over the next 5 years. So I'd be looking to sell it at a 6% cap rate market. Now, there's it's very academic. We could talk about it for hours on how that is, whether that's conservative enough, not conservative, whatever it might be. It really will dictate or depend on the market in which you're investing in about how much that cap rate expansion will affect your sales price. But again, going back to the value add strategy, if you can come and increase the NOI and you can still do an expansion on exit of the cap rate and you still get a solid return for investors and those sort of conservative assumptions still work, then yes, investors will still be able to make money in the future because I've already modeled it out, assuming that we're going to sell in a worse market than we're currently picking it up at, if that makes sense.
Very good. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Reid Goossens. He is an expert on investing in real estate in the U.S. He originally came from Australia. His book is called Investing in the U.S., The Ultimate Guide to Real Estate. He also has a podcast called Investing in the U.S. We'll be back after this.
We're always talking business. Talk to an expert. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
We've all been there, struggling to keep up with credit card payments, searching for a simpler, safer way out of debt. Well, here it is. Cambridge Credit Counseling is a nonprofit service that has been helping people reduce or eliminate their credit card debt for over 20 years. Most of us have made late payments and even gone over our credit limits. Before we know it, our balances are out of control, and we can barely afford to make the minimum payments. If this sounds familiar and you're ready to take control of your debts, call Cambridge right away at 1-800-897-2200 for a debt-free analysis. Cambridge will work with your creditors and may be able to reduce your interest rates and get you out of debt fast. In fact, Cambridge's typical debt management clients save almost $150 every month on their credit card payments, and they're debt-free in just 50 months. So there is a simpler, safer way out of debt, and it all starts with Cambridge Credit Counseling. Call 1-800-897-2200 for your free debt analysis. Cambridge Credit Counseling is a Massachusetts-based nonprofit agency providing services nationwide. For complete licensing information, visit them online at cambridge-credit.org. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Many industries have been revolutionized by technology in the last decade. Books, music, TV, communications, and now it's happening to our money and the way we pay. Tune in to Breaking Banks with Brett King for a look at how technology and customer behavior will bring about more changes in banking in the next 10 years than in the last 200 years. Listen every Thursday at 3 p.m. Eastern Time, noon Pacific on Voice America Business Channel or on AM 1160 The Voice. You'll never look at your bank account the same again.
We're always talking business.
Talk to an expert.
Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Reid Goossens. He is a real estate investor. Originally was in Australia. He's now been in the U.S. for a while, a successful real estate investor. His podcast is called Investing in the U.S., and he's also got a book called Investing in the U.S., The Ultimate Guide to U.S. Real Estate. Welcome back to the show, Reid.
Thank you very much for having me.
Tell just people a little bit of what they can find at your website, reidgoossens.com.
There's a whole bunch of free informational stuff there for investors related to investing in U.S. real estate. There's another free ebook about how to start raising money successfully as a syndicator. Obviously, my podcast is there, a number of blog articles about underwriting, how to analyze deals, how to build your team. So there's a whole bunch of stuff there that are just, I put it out there for people to learn because we are in a sharing economy. So we've got to put it out there and people can learn more at reidgoossens.com.
Very good. So sometimes you're going to do construction, either renovation or possibly new construction. What do you do to kind of limit the cost of construction and mitigate the impact so that it stays under control when you're doing some construction on a real estate deal?
Yeah, good question. So there's a handful of ways you can control that. The number one way is in which you enforce a contract with a general contractor. And it might there's different contracts you can do. You can do a cost plus, which I highly disregard. Do not do that. The number one contract that I will go and implement with my general contractors is what's called a guaranteed maximum price. So we will sit down with the GC and I will say to them, okay, this is a scope of work. I need you to bid it out. I need you to give me a price on it, and I'll go to maybe 2 or 3 GCs. And I will say, this is a guaranteed maximum price. So what that means is that they will say, okay, I can deliver this project to you, and anything, if I open up a wall or if I, find some existing conditions that I did not foresee, it's sort of on them to make sure that they do their due diligence on the property in order to make sure they mitigate their risk and exposure to future costs, because it's going to be on their dime that they have to pay those future costs. And obviously, there's certain things that they may exclude from the contract, stuff like existing ground conditions, environmental conditions and stuff like that. But in general, I want to back my GC into a corner to make sure that he is, really understanding the scope of work and he's giving me the best price in order to go off and execute in a manner that is in a timely manner. Because I also have in the contract liquidated damages, and liquidated damages means that it's really a rattlestick that says, okay, if you haven't finished the project within X amount of months, I'm going to start charging you per day for the first 30 days, and then it will increase thereafter as time goes on and you've been delayed. So it's really making sure that the GC's put on notice in terms of his costs. It's a fixed cost for me. He's not going to come back to me and have a second bite of the apple and say, hey, Reid, I've got all these change orders I need you to sign. And they go, well, hang on, you should have understood the drawing from day one. So their change order is really on you. It's not my exposure, that's your exposure. And the second thing is obviously liquidated damages that we can have at the end of the period of construction. And if he misses that or misses the date, then I can implement these LDs, as they're called in the industry, and he would then essentially owe me money for being delayed, if that makes sense.
Very good. So if other people want to get into syndicating, how do you build a brand culture and mission statement to attract investors to want to invest with you?
Yeah, very, very good question. So there's a lot of people looking to get into syndications, and there's the biggest thing that I found when I first moved to the United States is you have to have a story. People are attracted to your story. So my story is that I've moved halfway across the world and to follow my girlfriend, who's now my wife. But also I was quickly realized how the benefits of investing in US real estate compared to my home country. So there's a story there, and people resonate to stories. So if you're sitting out there listening to this show and thinking, well, I'd love to be a syndicator one day, you've got to think about what value can you bring to others. And when I first started my brand, investing in the US, it was really because there was no one talking to international investors about the benefits of investing here in the United States. There was no one talking about what's an LLC. There's no one talking about what tax implications. I didn't even know what a credit score was when I first moved here. So all those things, I said, well, hang on, I could go and start a podcast about it, and I can start a brand around it, and I can be the number one, in that space because I'm the only one in that space. And then over time, I've obviously pivoted, and I'm inclusive of everyone, but I had to really niche at the beginning and drill down on what my brand was. I'm Australian. I speak with a weird accent. And how can that benefit me to attracting others into my sphere who want to learn from me, who want to invest with me, who maybe want to partner with me in the future? So all those things, everyone is standing on a mountain of value. You just got to untap what is your value, and in order to give it out to the world and give it out with free education like a podcast or an ebook or a blog, and build a digital assets around the brand. So the digital asset like a podcast, the digital asset like an ebook, blogs, as I said, interviews like this. All these things are evergreen information and content which people can learn from, and they can pick it up in 6 or 12 months' time and still be relevant today. So really, my brand was focused around creating a good story, a good mission statement, a good culture, and that there was the underlying theme of what I built my platform on. And then from there, I provided people with really good information where I interview obviously really great entrepreneurs so they can learn about the benefits of investing here in the United States. And that's, in a nutshell, branding 101.
Okay, very good. You also talk about creating business ecosystems to create true long-term wealth. What do you mean by that?
Yeah, good question. So I personally think of my investing platform like a table, right? And every table has 4 legs or has a number of legs. One of those legs is buying real estate. I can buy real estate and I'm going to get, I'm going to own part of the deal. I'm going to get cash flow. I'm going to get some fees because I'm the manager. But you have to develop other legs of the table. Otherwise, the platform isn't stable. So developing other platforms like maybe property management. You can bring property management in-house when you get to a certain size and scale. Maybe what we're doing right now is we're direct sourcing product from China. Because we have over 1,000 units in our portfolio, I can start ordering directly from China and I can make a bit of a profit on that. And there are ways in which you can create ecosystems. There's sort of other small businesses feeding off the core, which was essentially acquiring commercial assets. And from that, I can make my table more stable. And that is better for my investors because, we may not always be buying real estate, in a down market or where lending is tight. So we have to have other ways of income coming in. Obviously, through cash flow is a predominant one, but you have to have multiple different streams of income, and that could be through property management, like sourcing, maybe construction management, and the like. And that's how I develop, true wealth and stability for my investors and stability for the deals, because I can control many aspects of the process in order to execute these deals successfully.
So what are some of the advantages of buying real estate in the U.S. that do not exist in other countries? Since you saw Australia, how is the U.S. a better market to invest in?
Yeah, this is a great question. I love getting into this question. So you have to realise Australia, so if we're just looking on a macro level, we have, in the United States, I think you've got like 350 million people. You can inhabit from east to west coast, from north to south, from the Canadian border to the Mexican border. Americans, you can inhabit the entire country. In Australia, we only have 24 million people, and we can only inhabit about 18% of our land. So everything's really much landlocked around major cities. And the reason is because it's an arid country. So in the middle of Australia, there's literally nothing. Now, Australia is the same size land-wise, excluding Alaska, as mainland America. So think of, you guys have 350 million people. You have, you have all these different cities. You have New York, San Francisco, LA on one end. You have then Detroit on the other, and you have 200 million people you need to house in between. That spurs secondary markets like Charlotte, like Dallas, like San Antonio, different markets where there's moderate cap rates. Moderate cap rates meaning, say in New York and LA, there might be cap rates of 2 to 3%. In Dallas and the like, there may be cap rates between 4 to 6%. In Australia, we have cap rates as low as 1.5 to 2%. So even in those really nice, tier one markets like LA and New York, it's still very attractive because the cap rates are still higher than what they are in Australia. Combine that with the fact that Australia only has a very small handful of lending institutions. So multifamily does not exist in Australia because the government gets money from condo sales. So they call it strata title in Australia. And every time someone sells a condo, there's strata. And the sum of the parts is greater than getting taxes on an entire building. So, for example, if I was going to go build a 100-unit apartment building, call it multifamily, I would have to pre-sell X amount of units before the construction loan would get involved into the deal. So that means I've got to go down the condo route. I can't. The bank isn't lending on this future 100-unit multifamily deal where the net operating income is X, and they can then value it based on the market cap rate. So the lending environment in Australia is very limited. Compared to America here, where you have agency debt, you have non-recourse, you have interest rates that are fixed for 12, 15 years. That is unheard of in Australia. And the fact that you have non-recourse debt here in the United States is also adds to why it's such an incredible country to invest in.
Okay, we're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Reid Goossens. He is a real estate investor expert. His book is called Investing in the U.S., The Ultimate Guide to Real Estate, to U.S. Real Estate. Also, the name of his podcast is Investing in the U.S. We'll be back after this.
Stocks, bonds, investment opportunities, financial news, and talk. We can help. Call us now toll free, 866-472-5790. 866-472-5790. Voice America Business Network.
Do you or someone you love have a life insurance policy that's no longer needed or not affordable? Did you know that you can sell your policy for cash? Your reason for buying life insurance has probably changed. Thousands of Americans turn to life insurance settlements to help sell their policies. They act as your representative, getting the highest market offer for you. You've got nothing to lose by simply inquiring. If you're over 64 with $100,000 or more of life insurance, you may already qualify. Call 877-485-6681 to get your free non-binding appraisal or visit fundinglife.com. Life Insurance Settlements. Discover the true value of your life insurance. 877-485-6681. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
If you're like me, the list of books you want to read is never ending. You simply don't have time to read them all. Blinkist has solved this problem. Blinkist is the only app that takes thousands of the best-selling nonfiction books and distills them so you can read or listen to them in under 15 minutes, all on your phone. I like to listen to Blinkist while I commute to my office. The Blinkist library is massive, from timeless classics like Rich Dad, Poor Dad, to current bestsellers like Fire and Fury Inside the Trump White House. My personal recommendation is to check out the 4-Hour Workweek. Right now, for a limited time, Blinkist has a special offer just for our audience. Go to Blinkist.com/moneyanswers to start your free 7-day trial. That's Blinkist, spelled BLINKIST.com/moneyanswers to start your free 7-day trial. You can cancel anytime. Blinkist.com/moneyanswers.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Reid Goossens. He is an expert on investing in U.S. real estate. His book is called Investing in the U.S., The Ultimate Guide to U.S. Real Estate, and his podcast is also called Investing in the U.S. Welcome back to the show, Reid.
Thank you very much.
So we were doing a little bit, but let's do a little bit more on the advantages of investing in real estate in the U.S. compared to other developed countries.
Yes, so we spoke earlier about the lending benefits. We spoke about the different tiers of market because of just the sheer population that needs to be housed in this country. We can also talk about the cost of living. So in the United States, comparatively, again, you have New York and San Francisco and LA are very, 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 very expensive. They would be the equivalent of, say, a London, or where I'm from in Australia, Sydney and Brisbane. They're about on par. So the cost of living is quite high. The barriers to entry in terms of getting into your real estate market are quite high. But then, go back to these secondary markets where the cost of living is more moderate. There's good jobs and people can afford a house. When I first came to the United States, I was gobsmacked at the fact that I could buy a property for $50,000. You could never buy a property in I want to say, at least in Australia, but in probably the Western world, as low as that as you could here in America. And so, again, it goes back to just the sheer advantages of just getting into the market. The barriers to entry are so low that it was just right for me to give it a crack. So low barriers to entry, good financing, good diversification in terms of jobs and where those jobs are located, strong GDP growth, and obviously the advantage of non-recourse debt. Also, the other thing I want to talk a little bit about is the GDP in general. So, just example, Texas, for all your listeners out there, has a bigger GDP than Australia. And California is even above that. So, just in terms of the sheer amount of money being generated in one state compared to one country, is huge. So again, those are just the sheer volumes that create those really details of really incredible investing opportunities here in the United States, and a good job diversification and good tax incentives as well. Obviously, the most Western countries do have tax codes that are written for real estate investors. America, Canada, Australia, England, stuff like that. They are there. They've been written because those governments in those countries, including the United States, are not in the business of housing, the citizens. So people who are investors do benefit from, deferring taxes, writing off certain interest rate payments, depreciating assets quicker. So there are different benefits like that. One of the big benefits for me that I first saw when I came here was 1031 exchanging. We do not have that, definitely, at least in Australia, as far as I'm concerned. As far as I know, I don't think there's any other country in the world has a 1031 exchange. And for those people who aren't knowledgeable about that, it's really any gross profit you make on the sale of a property, you can roll that profit over into a like-kind asset. So meaning if you sell a single-family house and you buy another single-family house, you will not get taxed on the capital gains. In Australia, that does not happen at all. Anytime you sell a house, you'll be hit with the tax then there, and then you will be left over with whatever you left over to go buy house number 2. So again, from a scaling point of view, you can buy a 10-unit property here in America, sell it in 3 years' time, make profit, then buy a 20-unit, then buy a 40-unit, then buy a 100-unit, and keep building your portfolio over a period of time, which really, really does lend to long-term wealth creation. And again, it's just one of the many benefits here in the United States.
So as you say, it's a big market. So how do you identify the properties that you want to buy? Are you looking on multiple listing service? Are you going to properties that aren't on the market? How are you identifying the properties you want to be investing in?
Yeah, so another good question. Given where we are in the market cycle right now, commercial assets are very, it's very hot. Like a lot of real estate is in the United States at the moment, but there's different pockets. So when I look, when I hear someone say, "Oh, the U.S. housing crisis or the U.S. housing market," I sort of scoff a little bit because there's 400 metropolitan statistical areas in the United States, and within each MSA, there's a north, south, east, and a west. And within each of those suburbs, there's certain, streets to keep away from. There's certain streets that are, certain suburbs that are more affluent, and it's so much diversification within the United States and within each market that you can get creative in terms of how you're finding deals. So yes, I do look for value-add deals, typically built in the 1980s or 1990s. I would like to buy direct from sellers, but in this hot market, we're probably we are going down the brokerage route. So we're really spending a lot of time developing the relationships with brokers, and those brokers are bringing us off-market deals in order because they know we can execute. So that's typically how we're finding our deals these days through our broker relationship network.
You're saying off-market deals, things that are not in the multiple listing. Is that what you're saying?
That is correct. Yep. So we're just about to purchase a deal in Austin, Texas, which was fell out of contract. It was not marketed, and the owners, we knew the owners, but the brokers came to us and said, "Oh, look, we're not going to market this deal. If you want to take it down, it's yours. You've got 2 weeks to decide. Otherwise, we're going to go start marketing it." So stuff like that. We're getting their pocket listings before they're hitting the market because of our relationships with the brokers, because we've proven that we're closers. We approached it first before the other people are approached, which gives us obviously a benefit.
So what I don't understand is how you buy a property. You must have to put a lot of cash up. If you're then syndicating it after you've purchased it, that's going to take a while to raise the money. How do you finance it in the short term before you've syndicated a particular deal?
No, good question. So to put a deal under contract is typically, let's call it $200,000. That is my business partner and ours money. We go put that down. We'll lock up the deal, and then we'll negotiate probably a 60 to 90 day close. And in that 60 or 90 days, we will raise the entire equity in that portion before we close. So we do not do any post-closing raising. We would have already raised all our capital within 60 days because we have a strong investor network. So who are really hungry for these deals. We can typically raise anywhere between $5 and $10 million worth of equity within 30 to 60 days.
I see.
Just because of the way we've built our network, we've built our investor database.
So what are some cities, kind of moderate in the middle of the country, cities that you think have good potential for apartment buildings these days?
Obviously, the Texas markets I spoke about, just because I've invested heavily in Texas. Houston, San Antonio, Austin, Dallas, they're obviously very good markets. I do like other markets like Jacksonville, Florida. I like the Tampa Bay area as well in Florida, up towards Orlando. I'm definitely looking for corridors between major cities in for example, the Austin, San Antonio corridor. I truly believe that will be one major city in 10 to 15 years' time. Similarly with Orlando and Tampa, again, that highway of growth. I'm looking for those types of connecting highways where there's maybe some small MSAs now, but in 10, 15 years' time, there's going to be all one metropolitan. I'm looking for good job stability, so I'm not looking for one particular major employer. I'm looking to have at least 5 to 10 major employers in the MSA. I'm looking for moderate cost of living, and I'm looking for a growing population. I think that's the most important thing. When you're looking at any new market, make sure that over a period of time that the population is increasing. You do not want to be investing in a declining population MSA.
Yeah. Okay. So you talk about putting together an A team. What are some of the people you know? Because you're not managing these properties yourself. You're having other people doing it. What do you need on your team to make this strategy work?
Yep. So regardless if it's a syndication or if you're just investing in single-family housing, you need to develop an A team. So who does that look like? So the number one, or one of the top people on your team will be a broker. Having those relationships with brokers, particularly if you're investing out of state, is really, really important. They will be able to bring you leads, so you can analyze them and hopefully go and close them. But you've got to develop relationships with brokers over a period of time. The second person on your team is going to be a property manager. Boots on the ground, someone who's going to look after the day-to-day management. We hire professional third-party property management teams in our different markets that we invest in, and they oversee the day-to-day management. They oversee the leasing. They oversee addressing work orders and stuff like that. The third person is really critical in your team is going to be your local attorney who can oversee any closing processes or any legal issues that you might have, and that they will be able to guide you through to the closing period, the closing date. Then also you're going to need a general contractor. Sometimes the GC is in-house with the property manager. I'd like to see them separate, so I'll go out and find a third-party GC, general contractor, in order to give me the most credible advice. And then the fifth person, you obviously want a tax consultant, who's someone who can look over your taxes and understand different structuring, because you have legal implications when you're investing, but you also have tax implications. So having two different players on your team, one in the legal realm and the other one in the taxation realm, will help you be the best investor possible, I should say.
Do you always visit a property before you end up buying it?
100%. I will spend, before I buy any property, 6 to 12 months visiting a market. It's getting quicker and quicker as we close on more and more deals, but we were looking in the Atlanta market recently, and my business partner and I probably did 2 or 3 separate trips, not together, but just to try and get out there, get in front of brokers, see deals, underwrite deals, give feedback to brokers to try and build that credibility with these local brokers. Because I need to understand, when I'm underwriting my deals, what are the assumptions? What are the rent growth assumptions I'm going to use? What are the expense growth assumptions am I going to use? Can this market support, a $1,200 or $1,300 rent for 2 bedrooms? Or maybe it's more of a market like an $800 or $900 for 2 bedrooms. So you've got to really understand, where the path of progress is and get boots on the ground to touch and feel these buildings and really what's going on, where the growth pockets are happening. And so that's what I like to do and be educated, because I think that one of the biggest mistakes people make is not getting out and seeing and touching and feeling the asset in which you're buying.
Yeah, very good. Okay, we're going to take a break. This is Jordan Goodman of The Money Answer Show. My guest this hour is Reid Goossens. He is the author of a book called Investing in the U.S., The Ultimate Guide to U.S. Real Estate. He also has a podcast called Investing in the U.S., and you can find out more at his website, reidgoossens.com. We'll be back after this.
From the boardroom to you, Voice America Business Network.
Attention heroes, current and former firefighters, law enforcement, military, medical, or educational professionals. Heroes can receive rewards averaging over $2,500 when they buy, sell, or refinance a home. Heroes come first. Along with the Homes for Heroes is the nation's largest hero reward program. Their mission is to provide extraordinary savings to heroes who provide extraordinary services to our nation and its communities every day. Learn how you can purchase a home for no down payment, no closing costs, and get money back at closing. Find out how you can own for less than you may pay for rent. Get your hero rewards at heroescomefirst.com. That's heroes, HEROES, comefirst.com. 888-437-6114. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth and Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth and Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth and Equity 888-262-5540 or visit truthandequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Reid Goossens, expert on investing in U.S. real estate, even though he started off in Australia. Welcome back to the show, Reid.
Thank you very much for having me.
So let's just talk a little bit about further the tax benefits that are offered in the U.S. There's something called depreciation. There's cost segregation. Just briefly go over the main tax benefits that people can take advantage of to increase the return on real estate.
Yeah, so when you're comparing a hard asset versus, say, a paper asset, your investment, the reason that you invest in hard assets like real estate is because the cash flow, or the dividend, let's call it a dividend, so we're keeping it all the same lingo, the dividend received from that property can be offset by depreciation. Unlike in say, a paper asset, if you get a, say, let's call it 10% cash-on-cash return in year one, well, that's going to be viewed as income, and that's going to go and probably be taxed at 30%. So you're not really getting 10%, you're really getting 7%. So in real estate, how do we do that? How do we go and, Reid, how does 7% stay 7%? Well, the reason is because we can come in and the cost of the real estate can be depreciated over a period of years. Now, in residential, it's 27.5 years, and in commercial, I think it's 35 years. Don't quote me on that. One of the benefits of investing in commercial real estate is because we can do what's called cost segregation, which means we can accelerate the depreciation of certain elements in the property quicker than 35 years. So what am I talking about? I'm talking about stuff like flooring. I'm talking about appliances and fans and blinds and, siding and roofs and all that sort of stuff. They can be depreciated a lot quicker than what the IRS dictates in the tax code over a period of 27.5 years for residential and 35 years for commercial. And so that means that when I get a return and then my depreciable ownership of that particular investment matches. So if I have $7,000 income in year one because I've invested $100,000 into this deal, but yet my depreciable tax benefits are also $7,000, so I'm net equal. So I don't have to then pay any taxes on that income. Now again, consult your tax.
So it's sheltered by depreciation. You're saying, yes.
Sheltered by depreciation. That's correct. And so that is then a benefit. Unlike other cost segregation, in Australia, we definitely don't have that accelerated depreciation that you can capture here in the United States. Now, the reason, how would you go and do cost seg? Probably the question would be coming up to most listeners would be that cost seg only makes sense when you're in larger assets, because to go and do a cost segregation, the IRS requires that you have a qualified third-party person go and execute that. And that typically costs you in and around $5,000 to $6,000, $7,000, maybe $7,000, depending on the size of the asset. So in single family, it's maybe not necessarily makes sense to go and spend that much money to get someone to do a third-party audit, because that may not be this. Your benefits may not be that great. But when you're dealing with a 200-300 unit property, going and spending $7,000 to realise, call it $1 million worth of depreciable value, that's a huge upside to all my investors. So they obviously go and execute on that, and they're just, again, some of the really awesome benefits of investing here in the United States.
So when people are investing, you say they're investing $50,000, and they're getting a certain cash flow. Do you have like a K1 that says how much of the depreciation is sheltering the cash flow they've received?
That is correct. Yep. So all structures that we own these assets in are what's called flow through. So investors will buy shares into an LLC, and that they will own a portion of the deal. So their portion will also have the tax benefits. And on their K1, it states, okay, this is your income, this is depreciable loss, and so this is your sheltered income, as you mentioned earlier. And that's all, as you said, stated on a K1. Again, something I didn't even know about when I first moved to the United States, but I had to educate myself on.
Yeah. Okay, so there's depreciation with cost segregation. We talked about the 1031 exchange. What are some of the other major tax benefits people can benefit from in investing in the kind of real estate you do?
Yeah, so obviously we pay interest on the loan that we get. That is also a taxable event, and we can ride that off against our taxes. And again, because investors are co-owners in our deal, they can also benefit in those interest rate deferrals, so reducing our taxable exposure by offsetting it with the interest rate payments. Again, something that is not done. I know in Australia they are thinking about taking that away from people, offsetting your tax with your interest payments. But again, here in the United States, it's very, very common to do that, and another great benefit of investing in real estate.
Yeah. So what role should real estate play in somebody's overall portfolio? Not saying people should put all their money in real estate. If they've got stocks and bonds and 401ks and gold, what role should real estate play in their overall portfolio?
Yeah, look, I think you have to sit down and ask yourself, what do you want to get out of, why are you investing in real estate? Is it for a retirement plan in 20 or 30 years' time? I do think diversification is very healthy across all what you just mentioned, stocks, bonds, gold, minerals, and real estate. I would personally want to see someone's real estate portfolio be, between 40 and 50% of their of their portfolio. I think real estate does have the best returns over a long period of time, and the fact that you can force appreciation rather than you have a lot more control in real estate compared to, say, the stock market. So my personal opinion is, between 40 to 50% of anyone's portfolio needs to be tied up in real estate.
Very good. So in kind of summarizing the whole situation, who should be investing in real estate? And, you're talking about syndication. Who should be an active investor in doing the kind of things you do in real estate?
Yeah, so let's talk about the first part of your question, which was who should be involved in real estate. I think everyone should be involved in real estate. Whether you're passive or active will depend on the personal situation. So, do you have time to go find deals, or are you just too busy with your day job, with your kids, with your life? Maybe that's an issue for you. So you have to really look at maybe being a passive investor, but you still want the benefits of investing in real estate, but may not necessarily want to go do the work. So syndication might be more that person's or that people's choice. In terms of doing what I'm doing, yeah, look, if people strive to be a syndicator, an operator, then yeah, everyone can do it. Again, it goes back to building that brand, building that that credibility first and foremost, to then go off and be able to raise capital, because we mentioned earlier in the show that raising capital is probably one of the hardest things to do. So making sure that you have your all the eggs, not having all the eggs in one basket, and making sure that you can raise that equity prior to closing on the asset is very, very important. So it goes back to personal brand. The reason why I'm a syndicator is because I get to control the asset, and I get to use other people's money in order to grow my wealth, but I also get to grow their wealth, so it's a win-win for me. And I come from a world of ground-up construction, and because I'm a former structural engineer, that I'm that sort of engineer brain, the black and white brain, where I want to go and take things apart, put it back together, and figure it out, and really be in control of my life and not have to work a day job anymore, because I work for myself and I work for my investors.
Excellent. Very good. Well, thanks so much. My guest this hour has been Reid Goossens. His book is called Investing in the U.S., The Ultimate Guide to U.S. Real Estate. His podcast is also called Investing in the U.S., and you can find out more at his website, reidgoossens.com. Thanks so much for being a guest on the Money Answer Show, Reid.
Thank you so much, Jordan.
Thanks again. We'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.